February, comparing and contrasting what we've had before now. Well, that's for that. But let's talk more about this. And an investment analyst at Chapel Hill, Denham, Nabila Mohammed, joined me while I get to my seat to continue this conversation. Nabila, thank you so much for being on the program this afternoon.
Thank you for having me. Good afternoon, Stephanie.
Yes, I'm sure you heard my introduction, seeing what happened to inflation with that flip after the rebased inflation for the month of January. And finally, we are here. 23.18% is what we have. So does this clearly mean that we are getting the steady decline? Or what do you make of the figures? Are we getting to that point where that graph is starting to tilt downwards?
Very good question, Stephanie. So I would say that we have been expecting that the inflation rate will steady along the lines of 24%. In fact, this particular 23.18% came in lower than we expected because we had penciled in 24.5% for the month of February. But I would say the best way really to look at the inflation numbers is from an average standpoint, because in the report, they did disclose the 12-month average to be around 30.09%. And that is what really should, or in my opinion, truly reflect the current situation. Yes, we've seen 2 steady months of disinflation based on the new methodology for computing the CPI. However, a much truer picture of what the inflation is, the situation of the inflation rate in Nigeria is, should be from an average standpoint, and that is what I believe market people in the market really should be observing and paying attention to. So yes, we like that in the month of February it has come in lower. We did attribute it to a slower rise in terms of general price levels of goods and services compared to the previous month. Even though we're looking at 2 different methodologies here. For based on this new methodology, we have explained that the prices on goods like yam tubers, potatoes, and a couple of other things that we mentioned, or sort of felt a slight drop on year-on-year figure for the food index, which we know still accounts for a large chunk of around 40% in terms of weighting in the overall CPI. Having said that, that resulted in lower inflation rate for February 2025. However, the best way to really look at it is from the average standpoint, which currently stands at 30.09%, because you would ask a layperson or someone in the market now, or just someone in the economy that is, transacting on a daily basis, and they will tell you that prices of things are still high. So what are they saying? That inflation is 23.18%. That is why a truer picture really is from the average standpoint, which they reported around 30% for the last 12 months.
I want to take you back to food again. What do you think, before we delve into other aspects of the figures, what do you think really needs to be done more to help address the price of foodstuff? Nigerians are worried and they are always concerned when it has to do with food. We see what's been happening in recent times, a bit of decline, and everyone is beginning to commend government already. But holistically, a lot of efforts are being put in. Can we have some specifics? What can we do to help address price of food? If that is done, I believe part of a problem is solved.
You're very correct. Yes, we have structural issues that will take sort of a longer time to address. Structural issues, I mean, security or lack of infrastructure. But generally speaking, what the government or what can be done is to make an environment that is conducive for businesses. Because when we talk about food, it's produced by businesses, produced by a particular sector or a real sector of the economy. So if they are into manufacturing, why not make it easy for them to manufacture these goods by making sure there's steady power supply, by making sure there's access to funding? In fact, with this inflation rate, we're expecting that come the meeting in May, we may see interest rates. We've already started to see interest rates drop down. So that will mean businesses will have access to funding and not at an expensive rate. And that would also mean they will be able to put funds into their business. And when a business can do that, it will not pass the cost unnecessarily to consumers. I will not see prices of goods and services just moving here and there. So ease of doing business is one thing. And one way to address it, of course, is to make sure that the infrastructures that these businesses need to, perform their work entirely is truly addressed, and they have access to funding at, affordable rates eventually. That will not necessarily translate to a higher prices for consumers at the end of the day. So looking at these issues from a structural standpoint really is how we can address food inflation and also addressing issues around insecurity.
Now, others are let's look at other aspects of this moving forward. We've seen that handshake, and we've talked about this many times during this program, between fiscal and monetary, aspect of government. Now, we see that handshake is very, very important, and we need that handshake. And many say we have it better than what we used to do. But now, if we are looking at the tax reforms, which is supposed to come from the fiscal side to help complement some things that the monetary policy deciders are working on and all of that, would you say we are also on the right track looking at that? We've seen the House of Reps and Senate, the hearings and all of that. If this is completed, and the monetary sides also continue what they are doing, we see what the central bank is trying to do around the FX market, and there's a bit of stability in that space. Do you really think that inflation will start to drive down and we won't have this hike moving on in the year?
I mean, if you tie everything all together, yes, we are seeing that handshake slowly, because if the CBN is on one hand trying to mop up excess liquidity, we should also see that the BMO on the other hand, when they are offering their hiking interest rates in order to make sure that they have or raking money and mop up everything that is in the system. So there's that handshake where they are both trying to address inflation from their various standpoints. Now, if you bring in tax reform bills into the picture, we see that they are trying to make businesses that actually account for a large chunk of Nigeria's economy. By what I mean, I'm talking about the SMEs now, how they have lifted the band in terms of the turnover that is qualified to be taxed based on the CIT and just other specific. If they have done that, it means that they are encouraging businesses to actually thrive in this particular, if these reforms are truly passed. So that is one way I believe that they are trying to address the ease of doing business. And when there is ease of doing business in the country, of course, it will not translate to them having to pass price increase or something to the end user, because they are doing their businesses with ease. There is no unnecessary cost involved in terms of tax. So all these reforms need to really tie well, of course, with what the monetary policy authorities are doing, or else we'll be having, a bit of divergence in the way things are playing out, and that will not be healthy for inflation. So I would say yes, they are on the right track, and I would just like to see them monitor things more closely in order to make sure that everything is still working in line with what the agenda is, which is to bring down inflation. Let's recall that the target based on the budget is around 15%. And if we're currently at 3.18% and structurally things are fixed, it will mean that in the next what would take us to around 15%, next like 78 percentage points down, we should be at the 15% target. But it is not just going to happen by changing the numbers. It would happen, of course, by putting things in place and making sure that all pain points that will lead to rising inflation are addressed adequately.
Let's take it from there. The NBS is maintaining that the rebasing is designed to ensure that Nigeria's economic indicators reflect the current structure of the economy. Do you agree with that from the inflation figures, and we're expecting the rebased GDP to also come up very soon? Do you also agree that this reflects the current structure of Nigeria's economy?
I mean, if we look at it in terms of what they said they would do and what they did, the items that are being measured in the basket have increased from 700 plus to around 900.
900, yeah.
And that is exactly what you would expect for how we've grown so much as an economy. I mean, coming from 2010 that was previously to today, our spending patterns have changed, our consumption patterns have changed. The goods and services that we now patronize have changed. I mean, what surprised us the most was the fact that in January we had alcoholic beverages as the fastest rising in terms of inflation rate on a year-on-year basis. This year we're having, this month rather, in the month of February, we're having restaurants. So it means truly something has changed. And for that to really be captured, it was necessary, of course, for them to reveal it and factor in all these other areas that we think people do not spend money on, and they are seeing some level of price increase over this long period of time. So I would say that yes, truly this is more or less like showing a true picture of where monies are being spent and where consumption is taking place the most in as the months go by. So if that is the case, if that is what they have done, yes, it is reflecting in what the numbers are coming out to look like. In January, as I mentioned, we had alcoholic beverages as the fastest rising sub-index. This month again, we're having restaurants as the fastest rising index, not even the food itself. So you can see where what this particular revision has done, not just increase the number of items being measured, but also factoring in all these other areas that are also experiencing some level of inflation or rising inflation, as I put it.
Getting more interesting, the stability in the FX space is also something that many have talked about. You're an investment analyst, and I'd like to ask you the question around that investment space. Do you think that with this stability, I'm sure you saw the Chatham House report saying currency is now more competitive, considering the devaluation and all of that. But do you think that we are now set to attract the needed investment into the country, considering all that we've seen before now?
Yes, stability is one thing that investors look at, especially foreign investors, because they look at how transparent the market is, how confident investors are in the market, how stable the FX is, and not that today they have invested, tomorrow it's something else in terms of the value of the investment. So stability is important. But again, interest rate also plays a huge role in terms of attracting investors, and we still have that high interest rate. Even if we come to May, when the next MPC meeting will hold, and they decide to, become dovish, we don't expect it to be aggressive, because they are still going to watch out for March inflation trends, April inflation trends before they decide they meet in May. And all this will shape what the expectation will be in terms of market rate. But we like what we're seeing in the FX market. We like the stability that we've seen, the relative stability that we've seen and since the start of the year. And this will, of course, attract, that foreign eye in terms of, okay, this country looks like it's ready to, house things. But there is more that needs to be done. We should not go to sleep yet, because it's too soon to start clapping. We should just watch out for how things play out, because a lot of things, again, just affect the stability in FX. And if they monitor all those things closely, we should get there, or at least, experience some level of foreign flows into the economy, whether in form of direct investment. In fact, particularly in form of direct investment, because that's what is long lasting compared to foreign portfolio investors.
Exactly. We have more of the FPIs coming in at the moment, and that's what many are worried about. This hot money comes in and goes out almost immediately, and everyone is worried about that. So looking ahead again for the expected GDP rebased figures that we expect anytime soon, what is your outlook, or what is Chapel Hill expecting with regards to that?
So first of all, we are expecting a bigger economy in terms of size, because if they do add, include all the other sectors that will really be captured in the computation of GDP output, we should see a stronger and a bigger size economy. How big? We shall wait and see, but that is the expectation. We don't expect it to still be at 270 trillion based on the last print that we had in Q4 2024 or for the full year 2024. Aside that, we should also see that economic growth, especially with all other macroeconomic indicators remaining stable and becoming better, we should see more activities pick up, and of course that will translate to better growth. In fact, for the first 2 months of the year, January and February, we've seen the Purchasing Managers Index, which is like a leading indicator of economic activities, remain above the benchmark of 50 points. And this is positive. It just signals that there's business optimism, there is improvement in business activities, and that, of course, again, will feed into the growth that we record in Q1. So we're still expectant of the GDP retail numbers, and we cannot wait to see what how they adequately capture all the other sectors, formal sector and other sectors that you mentioned will be captured. We're expecting again a bigger size economy and stronger growth going forward.
We saw the services sector playing so well in the last GDP figures that we saw for the Q4 of 2024. Other sectors didn't do pretty well. Well, even the agricultural sector didn't do so well. Are you thinking that the services sector will still take the shine moving on?
So that's the tricky one, because services is quite, strong, and throughout the quarterly figures that we saw last year, we saw the services sector really being pushed by the performance of the financial services as well as the ICT space, despite the headwinds that they experienced. That's for the ICT, of course, but they still remain strong and pushed the overall services sector. And I would say for the full year 2024, all the sectors actually did better than they did in 2023. And this just speaks to some of the improvements, especially when we look at industry. Industry, for instance, we saw a rebound in oil refining activities. I mean, from a contraction of around 35% in Q4 2023, we saw a positive growth in oil refining activities in Q4 2024 of 9.59%. And that just shows us that, yes, something right is being done, even in the other sectors that we think are not really playing a huge role. So if we see stability in FX, if we see, that will translate to lower FX losses for these manufacturers or the real sector of the economy, we should see some level of activity pick up in the industry space. Now, if we also see some other investments that they're doing across mining and other subsectors under the industry as a broad sector, we should see activities pick up, just like we saw mining pick up. So I would say it would be, a very competitive push, because just going back to the PMI data that I earlier mentioned that was published by CBN, we saw agri come out the strongest in the month of February. It printed 53 points, and that just shows that some level of activity is ongoing there. And we are starting to see news flows around investment. In fact, I think I saw one today around Nigeria and Brazil trying to do something in agriculture space in terms of just improving things that are in there. So it's going to really be a push, and we are all up for it, to be honest. We want to see activities pick up across board. We don't want a situation that the growth or the economic output of the country as a whole is reliant or dependent on just one sector alone. There should be like a competition among these three sectors to get things right. So it's good that across board we are seeing some pickup, and that is sustained. Of course, that's when we will see a positive figure, a positive turnaround in all economic activities going forward.
Nabila Mohammed, investment analyst, Chapel Hill, Denham. Thank you so very much for joining us on the show this afternoon. We always appreciate your time. Thank you.
Thank you for having me, Mr. Philip.
Enjoy the rest of your day. All right, then, still to come on the show, we will shift our focus to the oil and gas industry. We've been talking much about petrol pricing, but we'll look at this petrol pricing war, crude oil production in a deregulated market. And I have the Chief Operating Officer, owner and country manager, Trade Grid, Mr. Jide Pratt. He joins me after this break